In this video, we are going to look at a long trade in the US dollar against the Canadian dollar using a second-degree fractal hybrid divergence in the 30-minute timeframe. In number 1 we can see the last confirmed high that was created by the same sellers who produced that massive drop in the market a few candles back. At this point it's clear that sellers are not nearly as strong as they were in those two highly volatile candles. In number 3, we see a new pack of buyers trying to disprove this market by attempting to break the last confirmed high where sellers showed up significantly for the last time. Sellers managed to create a bump back down in number 4, but buyers picked the market up again quickly and broke the high number 1. I want you to notice how organized the movement between 4 and 5 is. Look at how every candle produces a higher high and a higher low. This is suspiciously organized, and it might be the product of some market maker trying to trigger retail traders to go long in a bad trade location or trying to trigger stop orders that were above high number 1. Notice also that now the market is creating higher highs and higher lows, so it makes sense to look for optimal places to go long. Another important detail here is that the next significant pack of sellers that might hinder a long trade idea is relatively far away, and it is around the opening of the first massive candle down. As far as the momentum analysis of the market goes, notice that between 4 and 6 we have a simple hidden divergence marked by the short red lines. Number 6 happens to be a fractal candle, as we can observe by the offset between the lows from candle 6 and its previous candle and the corresponding peaks in the relative strength index. Once again, we are only considering number 6 as a potential low because of the second-degree hybrid divergence we are able to see here. Beyond that, we see that the tail of the fractal candle number 6 landed exactly in the supply and demand zone that spiraled from the turning point between 2 and 4 and then from 3 and 5 marked by the narrow black rectangle. Another interesting fact about the market vectors between number 2 and number 6 is that the retracement between 5 and 6 is approximately the same size as the retracement between 3 and 4. Since we are dealing with an organized and clear market up to this point, this observation adds up to our long trade bias. Notice also how the narrow black rectangle acts similarly to a support and resistance line. These are called supply and demand zones, and the logic sustaining such idea is simply the determination of zones where buyers and sellers shift the control of the market. This is a very simple trade idea because this market is quite clear and noise-free. Our current long position was triggered in the open of the candle right after the fractal candle number 6 with a stop loss a few pips below number 4 for a double layer of protection. Our target was placed in the blue horizontal line coming out of that candle with a large upper tail on top left corner of the chart. Notice that before our trade can have a free pathway to hit that target, the buyers on which we're counting must be strong enough to surpass the ignition point of that first massive bearish candle marked by the horizontal black line. If this analysis holds up, we will be looking to collect a nice 1 to 4.5 risk-reward ratio trade, which is well within the realistic range we established by looking at the logarithmic nature of the margin of error increments. If you have been paying close attention to the trade examples in this course, you must have noticed that the combination of contextual trading with our unique approach to momentum analysis of the market is indeed critical to pinpoint the precise turning points of the market. One of the most difficult things to do as a trader is trying to know when the market is going to turn. Contextual trading aligned with the careful and clear-cut observation of the relationship between raw price action and momentum really makes the difference in the trade location aspect of a strategy. Let's see how the market develops. Here we can see the market hitting the target for a nice and simple trade using a second-degree fractal hybrid. A couple of interesting things I want you to notice in the market is the point number 8. Notice that between market vectors 5 through 7, the market created another crystal clear higher high and higher low, with 6 being a confirmed and solid market structure. We have a blue horizontal line that shows the turning point of the market vectors between 5 and 7. Candle 8 landed precisely in that turning point line. Notice also that in point number 8 we didn't have a fractal candle, but we did have another simple hidden divergence between 6 and 8. I am showing you this because fractal divergences do not happen in all minor and major turning points of the market. That's just a practical reality we need to deal with. However, there are other ways of triggering a trade without necessarily having a clear fractal candle, but we must be very careful with this idea. I want to grab your attention to the idea of clear momentum turns. Pay close attention to the market vector between 7 and 8. Notice that this was a perfect downward movement. Every candle creates a lower high and a lower low. In the relative strength index, we also have a downward line without any cracks, which reflects the perfect nature of our little market vector between 7 and 8. Notice that the very next candle after number 8 is a candle that completely breaks the perfect pattern between 7 and 8. It doesn't create a lower low, it creates a small higher high in the candle level, and the relative strength index begins to point up. When we have a break of a perfect price and momentum pattern like that, we can consider entering the market if we have other contextual elements supporting our trade idea, of course, which is clearly the case in number 8. We have the candle number 8 landing in a turning point line. We have a pretty good place to put a stop-loss order under solid market structure number 6. We have a clear simple hidden divergence happening and the market is obviously creating higher highs and higher lows in the major scale. Notice that candle 6 was also an obvious break of the perfect market vector from 5 to 6. However, be very careful with this idea because you might want to apply it everywhere without considering the proper contextual elements. More to the right of the chart, you can see a candle marked by the number 9. Notice that this candle plowed through the point of ignition of sellers we marked in the far left of the chart. Notice how easily buyers broke that level. This should give you a pretty good idea of who is in control of this market at this point. This was another simple example of the fractal flow method application in a clear market. Hopefully you were able to pick up the subtle details and nuances of the fractal flow method and how they make all the difference as far as precision goes.